Welcome everyone to our presentation, Tax Strategies for the Next Decade. I'm your presenter, Nick Hughes. I'm a certified financial planner and investment advisor representative for Visionary Horizons. What does that mean to you? Well, that means that I can provide financial planning and investment advice for a fee. Now, the topic today is on taxes, but none of the representatives with Visionary Horizons provide tax preparation or tax advice. Prior to implementing any of these strategies, we do recommend that you loop in your tax professional. And if you don't work with a CPA or tax professional, we'd be happy to refer you to a local professional. The topic today is on taxes, and taxes can be a little bit of a snooze fest, but I think Joe Zimmerman has a interesting take here that adds a bit of comedy and humor to the subject. So take a listen here.
My biggest fear about the government is just taxes. I worry about it all year long because other countries, the government will tell you what you owe and then you just have to pay it. Here, the government's like, okay, what do you think you owe us? I have no idea, just tell me. Nope, you gotta add it up. And then give it. Well, I'm really unorganized. What happens if I add it up wrong? You could go to jail. Oh, that's terrifying. Please, I'll pay you whatever you want. Just tell me. No, guess.
Now, how many people have felt like Joe Zimmerman at one time or another? Maybe you're self-employed. Not everybody receives their income from a W-2 where you may have tax withholding every pay period. You may have to pay in estimated quarterly taxes. You could be getting income from a number of different sources. Maybe you have real estate, maybe you have investment income. You could be getting a K-1 from a business interest. There are lots of different ways that you can receive income, and it can cause stress at tax time as you're gathering these documents together and trying to calculate what your income is. Well, today we want to take a lot of the stress out of tax time because we think that you should be thinking about taxes throughout the year, and we want you to be a lot more proactive with your tax planning. We're going to start off and go through a bit of tax history here. And we haven't always had a federal income tax here in the United States. In fact, the federal income tax came about through the Tax Act of 1862, and it was signed into law under President Lincoln. And you might not be terribly surprised that there weren't a whole lot of IRS agents at the time, but the Tax Act of 1862 set the tax rate for individuals with incomes above $600 a year at 3% and incomes above $10,000 at 5%. Now, needless to say, there weren't a whole lot of individuals that were actually actively filing their taxes at the time. So there wasn't really a mechanism to collect taxes, or really a very good mechanism and infrastructure to collect taxes. So our tax history has changed. Tax rates have gone up over time here in the United States. And you can see these are the highest marginal tax rates for those individuals that are at the highest tax rate throughout time. You can see what the tax rates have been historically. In the early 1900s, we still had relatively low taxes, but likely due to the spending that occurred through the First and Second World Wars, tax rates got pretty high. We saw a top tax rate of around 94%. If we look back at history, we have seen tax rates go up, particularly to pay for defense spending in a lot of cases. We did see tax rates start to come down quite a bit in the 80s. and they went down, uh, especially under Reagan. We saw the tax rates go down, but more recently, we've seen tax rates of around 39.6 in 2015. And you may remember that there was a big tax bill, the Tax Cuts and Jobs Act of 2017, that reduced tax rates for both corporations and temporarily for individuals. It dropped the top tax rate down to 37%. Now, if Congress doesn't act, by the end of 2025, then we could see tax rates revert to where they were prior to the Tax Cuts and Jobs Act, or that top 39.6% rate. And one thing that you can take away from this is this can be a opportunity for individuals. If you are paying less in taxes now than you theoretically would in 2026, there may be a window of time for you to realize some income at lower tax rates, when in the future tax rates will be higher if Congress does nothing. And as we saw with the recent crisis of the moment when we had the debt ceiling debacle this summer that finally came to a resolution, a lot of times Congress is procrastinating, and who knows, maybe they won't act at all when it comes to this Tax Cuts and Jobs Act, at least individual tax rates potentially expiring at the end of 2025. So there's really 6 things that we want to cover today. We want to recap some tax rules and tax terms. I think that there are a lot of things that are commonly confused, and so we want to help demystify some of these terms for you. One of the biggest questions that we get is it a good idea to convert a IRA, or for that matter, any pre-tax account like a 401k or a 403b to a Roth IRA? So we're going to go into some of the thinking around should you convert from a pre-tax account to a Roth IRA account. Now, healthcare laws have increased different types of taxes that we pay. There's also some things that you can take advantage of in the tax code as it comes to healthcare. We'll get into that. And one of the things that you can be more mindful of is with different types of income that you receive, either from investments or Social Security and pensions, the impact of your decision and when you realize that income can affect your taxes. So we just want to get you thinking more about that and just being a little bit more mindful of that, maybe having an overall strategy to how you want to realize your income. Now, I know most people understand, we're taught at a very young age that you want to diversify, but a lot of times folks don't diversify their tax buckets and the different types of accounts that their assets are placed into. But you can do that. If you have done a good job about that, it's also good to be thinking about tax smart asset location, which we'll get into that and share how you might be able to experience more growth after taxes just by being a little bit more strategic with how you position investments in different types of accounts. We're also going to talk about some tax advantage investments that may or may not make sense, but we want to give you the tools so that you can help determine if it does make sense for you with tax advantaged investments. So we're going to jump right in here and talk about some tax terms. One of the things that really simplified tax filing for a lot of individuals was we saw an increase in the standard deduction. So everyone got an increase in the standard deduction. And for 2023, there was an increase in the standard deduction to around $28,000. And if you are retired and over the age of 65, there is also some additional increases to the standard deduction. So the standard deduction is the amount that once you have figured out what your income is, you can take the standard deduction and that's going to reduce the amount of your income. Now, we're going to jump in and cover some key tax rules and terms here. Now, one of the things that made filing your taxes a lot simpler under the Tax Cuts and Jobs Act is that we saw an increase in the standard deduction. For 2023, a couple can take a standard deduction of $27,700. And for single filers, it's $13,850. And essentially, what that means is that instead of, if you were itemizing in the past, now you can just take this higher standard deduction. And if that standard deduction is more than all of your itemized deductions, then it makes more sense, obviously, to take this new higher standard deduction. So we didn't have to keep up with all of our receipts for donations and different deductions that we were taking, because now we've got this higher standard deduction. And so that can help reduce our taxable income with that new higher standard deduction. The other thing is that there was a cap on some of the deductions that you can take. So for instance, there is a $10,000 cap on the amount of state and local taxes that you can deduct. And that cap really penalized areas of the country where perhaps property values were more expensive. Maybe they had higher local and property taxes. And so there is a cap on that now. There are some other benefits that we saw. There's a child tax credit, and you get that $2,000 per eligible dependent. And that is if your modified gross incomes are below $400,000, you get to claim that tax credit. Now, one thing that I want to be very clear, sometimes people get tax credits and tax deductions confused. So a tax deduction is going to reduce your taxable income. And essentially it's going to, if you're, let's say you're in the 20% tax bracket and your taxable income is reduced by $5,000, then that's going to reduce your tax liability effectively by 20% on that $5,000 that you're taking as a deduction. A tax credit, on the other hand, will reduce your tax liability dollar for dollar. So if you have a $2,000 tax credit, it's going to offset your liability by $2,000. And all things being equal, a tax credit is generally going to be better than a tax deduction for that very reason. There's even some tax credits that are refundable. So if you have enough credits that you owe no taxes and it leads to a refund with a refundable tax credit, you can get that money back through a tax refund. One other thing that changed is with mortgage interest deductibility. Now there is a maximum of $750,000 principal value on your home for deducting your mortgage interest. So if you have a very nice large home and you've got a bigger mortgage than that, you can't deduct mortgage interest above that $750,000 principal value. There's another term, and it's really beyond the scope of this presentation today, but there's what's called an alternative minimum tax. And just conceptually, to give you an idea of what this is the IRS instituted the alternative minimum tax because they wanted to make sure that individuals couldn't get too many tax benefits. If they're taking a lot of deductions and using a lot of things to their advantage to reduce their taxes, the alternative minimum tax requires them to pay a minimum amount of tax. So this is a calculation that runs kind of parallel to their tax calculation that will require them to pay a minimum amount of tax, regardless of if they're taking some of these using some of these strategies. So they do want you to pay a minimum amount of tax, and that's where that alternative minimum tax can really kick in. So one of the big changes that we saw that came about this year is we saw the Secure Act 2.0. And this was a pretty large piece of legislation that affected different types of retirement accounts. Essentially, what Congress realized was that a few years ago, when they rolled out Secure Act original recipe, as I like to call it, was that folks here in the United States, they're not as prepared for retirement as they could be. And so one of the things that they've been doing over time is they've been pushing back the point at which you have to start taking money out of your pre-tax retirement accounts. And so those are what's called the required minimum distributions, or for this presentation, we're just going to use the term RMD. And the RMD age has been pushed back to now it's age 73. But if you're born after 1960, the age is going to be 75. So unless they decide to further push it back into the future, the age, if you're born after 1960, will be 75. So essentially a required minimum distribution, once you hit that magic age, be it 73 or 75, depending on when you were born, you're going to have to look at your account balance in your IRA, 401k, 403b as of December 31st of the prior year, and you are going to have to take a minimum distribution that's based on your life expectancy and a spouse that's deemed no more than 10 years younger than you. If you've got a spouse that's a lot younger than 10 years, then you can actually use a more favorable life expectancy to calculate your required minimum distribution. The key takeaway for this, these are things that we can help you calculate. There's also some calculators online that you can use. But the way that this works, and essentially what you need to know, is that you're going to have to take this distribution every year once you hit the magic age for yourself. And if you don't take that distribution, there is a penalty. The good news is that through the Secure Act 2.0, the penalty has now been reduced from 50% to 25%. So let's say that you had a required minimum distribution that you're supposed to take of $35,000. Well, in the past, if you did not take that, then there was a 50% penalty. So they're going to charge you a penalty of $17,500, plus you have to pay taxes on that $35,000 that you're supposed to take out anyway. So you're going to have to pull out the $35,000, pay taxes on that, plus pay the penalty, which in the past was 50%, but now it's gone down to 25%. Now, even though the penalty's gone down, we don't want you to have to pay this penalty. We don't like penalties. We want to avoid penalties. The first year that you are required to take these distributions, they do give you a little bit of leeway. So they actually give you until April the 1st of the year after you turn 73 to take your first required minimum distribution. So that's the first time they give you a little bit of leeway. The problem is if you wait until April 1st of the year after, you still have to take that RMD for the current year. So you're effectively taking two RMDs in the same year, which can push you into a higher tax bracket. Some other good things that came about in addition to lowered penalties is we now have a increased catch-up contribution. So now in your 401k or your qualified retirement plan at your employer, you can put an additional $7,500. That's gone up from $6,500 as what's called a catch-up. So if you're behind the 8 ball, that's a way that you can save more in addition to your maximum 401k contributions. They're also trying to make it more appealing for small businesses to start workplace retirement plans by establishing these credits for startup costs. Now, this is a strategy that we've used for a lot of individuals, and it used to be tied to your required minimum distribution age. But now that that's been pushed back, it's still at age 70 and a half. You can do what's called a qualified charitable distribution or a QCD from your IRA. And basically, how that works is you can take money out of your IRA, and that will, if it goes directly to a charitable entity like a church or a 501c3 organization, it has to go directly to them. So it comes out of your IRA and the check goes directly to that organization. It doesn't come to you first. Then that amount you do not pay federal income taxes on. So how does this come into play for individuals? Well, let's say that you're over the age of 70 and a half and you're already drawing money out of your IRA and you're making contributions to charity. But because of that increased standard deduction, you can't itemize your charitable contributions. So now this is a way that you can effectively get a similar benefit and not have that money that is coming from your IRA going to charity. You don't have to pay income taxes on that money by taking a qualified charitable distribution. You can only do it from IRA accounts, and you can only do it upon reaching age 70 and a half. But the big change that came about through the new Secure Act was that now the qualified charitable distribution, there was a cap at $100,000 per year. Now that's been indexed to inflation, so you can do even more charitable planning through the new rules under the Secure Act 2.0. There's some other things. I'm not going to go into these in great detail, but they want to encourage people to put money in retirement accounts, even if they're concerned about emergencies coming up. So they're going to start a provision that allows for emergency funding up to a certain amount in retirement accounts. That's going to be coming down the pike next year. And they're also going to do some things for individuals that are paying student loans where they can use student loan payments to count towards matching for retirement contributions. This is a really good thing if you've got a 529 plan and let's say your kids have made it through college, but they've got money left in a 529. Now there's more options for you to get money out without penalty because in 2024, they will allow you to roll money that's left in 529 plans over into a Roth IRA. Now, my understanding is that it's going to be subject to the Roth IRA contribution limits. And this is not something that you can really take advantage of and try to game the system by getting money into 529 plans and rolling it to a Roth in quick succession, because my understanding is that has to be in existence. The 529 plan has to be in existence for about 15 years before you can do these rollovers. Roth 401ks, Roth 403bs, they're no longer going to be subject to required minimum distributions. So with a Roth IRA, they never had required minimum distributions. Roth 403bs and Roth 401ks no longer in 2024 will have required minimum distributions once you hit your magic age. 2025, employers are going to be required to enroll employees in their workplace retirement plan. It's going to be an opt-out type of thing. Once you become eligible, you must opt out as an employee to not contribute to your retirement plan. They're also going to do something special for individuals between the ages of 60 and 63. There will be a special $10,000 catch-up that will be available for individuals that are in that age window of 60 to 63. So another way to get more and more dollars in your 401k. So if you're behind the 8 ball, you need some help. Hey, the federal government and Congress is coming to the rescue to help you with these provisions to get more money into your retirement accounts. Now, these are some things in kind of a timeline of the changes. So the corporate tax rates stayed in effect and were essentially made permanent unless Congress comes in and changes that in the future. But the individual tax rates and brackets, that is going to go away if Congress does not extend those by the end of 2025. So if Congress does nothing, everyone will be seeing their individual tax rates go up. So beware. This is an opportunity where you may want to do some planning here in the next few years to take advantage of this time period. Now, your investment income is taxed differently than your earned income. And so we have different types of ways that we receive income. Now, if you own stock, or let's say you've got real estate and you sell your asset and there is a gain, if you've held that asset for less than 12 months, then you are going to have a capital gain, but it's going to be a short-term capital gain. Your short-term capital gains are going to be taxed at your ordinary rate. So if you find yourself in the 22% tax bracket and now you've got short-term capital gains because let's say you're trading in your Robinhood account, you like to aggressively trade your Robinhood account, you probably have a lot of short-term capital gains. Well, you're going to pay a lot more in taxes on those gains by having short-term capital gains. If you flip houses, oftentimes you want to get those houses turned over very quickly. You don't want to have your capital tied up for very long. You want to move on and get some quick profits from your flipping houses. Unfortunately, the downside of that is that you are taxed as a short-term capital gain. Now, from an investment perspective, it's usually better to have gains over a long period of time because you're taxed more favorably. So you have a long-term capital gains rate of, if you're over about 90,000 in income as a couple, your capital gains rate is about 15%. Sometimes we can work it out to where individuals can keep their income really low and they might be able to realize some gains at a 0% tax rate. If your income is over about 553,000, then you've got this higher long-term capital gains rate of 20%. So beware of capital gains. If you have short-term capital gains, you're going to pay more in taxes. Whereas if you have those long-term capital gains, you have a lower tax rate. So buy things, have a long-term investing horizon, and hold things for the long term. It will help you not only from an investment experience standpoint, it should help, but also from a tax standpoint. So how can you manage taxes? So one of the best ways is in saving in what are called qualified accounts. And if you work at a company that offers a 401k, it's one type of a qualified account. And essentially what a qualified account is it means it's a type of account that gets special treatment. It's qualified by the IRS to get special tax treatment. And these accounts are all different types of qualified accounts. So the first is a 401k. And in your 401k, anyone as of this year can contribute up to $22,500 to your 401k. And if you're over the age of 50, you can do a catch-up contribution of $7,500. So you can put, if you're over the age of 50, you can put $30,000 a year into your 401k. You can save a lot of money in a 401k. Now with a 401k, that is going to essentially give you a deduction of that money that you defer into that 401k. So it's going to reduce your taxable income now, and that can provide you some tax benefits right now. If you're in your peak earnings years and you think that you're going to be in a lower tax bracket in retirement, it may make sense to put more money pre-tax into your 401k rather than say after tax into a Roth IRA. Now we look at another type of plan, and some companies offer what's called a profit sharing plan. So with a profit sharing, you can get even more dollars put away. This works really well if you're self-employed because you can do a maximum, the lesser of 66,000 or 100% of your compensation into the profit sharing plan. So that you can stack your 401k and also do the profit sharing to get even more money in. So as a small business owner, this is a great way to get a lot of money into your retirement vehicles and also save money on taxes. If you don't work for an employer that has a 401k, you can put money into a IRA, now a traditional pre-tax IRA. So with those types of accounts, you're getting a deduction of your contribution. So for this year, there's a $6,500 contribution limit, and you can do an additional $1,000 if you're over the age of 50. With a Roth IRA, that money is coming out after tax. So you're paying tax on the seed, putting it into the Roth IRA now, and in the future, you're able to draw that money out tax-free. So the key things with both IRAs and Roth IRAs is that money has to be left in till age 59 and a half to avoid any kind of penalties. That's actually true for any type of qualified account. You have that 59 and a half age limit. There is one exception with a 401k. If you separate from your company after the age of 55, they do allow you to pull money out of your 401k without penalty. But that's the one exception to the age 59 and a half requirement to avoid penalties. Another plan that we see, and this is more we see it often for solo entrepreneurs. So let's say you're a real estate agent or you really have very few employees. You may want to do something like a SEP IRA. You can do the lesser of 25% of your compensation or 66,000. And that's a way that you can get a lot of money into your retirement accounts. With these types of accounts, you do have to put in money for your employees as well. And you also want to be careful if you have multiple businesses because those related businesses may fall under that umbrella, and they may want you to contribute for employees of related businesses as well. So keep that in mind. If you want to have a conversation about what type of account is best for you, these are the types of things and discussions that we have, but these are as an educational resource, these are some of the types of accounts that you can contribute to reduce your tax liability.